Hey, what's up, guys? Evan here. In 2006 and 2007, there was a real craze in the real estate market. It was a time where real estate investors, realtors, and mortgage lenders were reaping huge profits. It seemed like everyone was making a fortune. Back then, if you owned a home, you were considered fortunate. The real estate market was on fire, and people were making substantial gains. I remember speaking to someone back then who mentioned writing about 60 loans every month. Compare that to only writing 10 or maybe 15 loans 4 years before. The shift was remarkable. I myself was working as a bartender at that time. Fast forward to today, and I'm a homeowner with a boat. But unexpectedly, the tide turned. Suddenly, the lights dimmed, and we find ourselves stepping into a scenario that echoes that era. Newsweek recently reported a disturbing trend in the United States. New homeowners are facing a rapid decline in the value of their homes. Data suggests an average loss of $122,000 in home value. This drop is staggering and a worrying sign for the American dream of homeownership. Over the past year, the American household market has experienced a seismic shift. Property values are plummeting. According to a November study by Point Two Homes, homeowners are witnessing a sharp decline in home values, with some single-family homes shedding up to 223s in value every single day. When you delve deeper into the housing market and the broader U.S. economy, it becomes evident that we're marching into what could be the most significant transfer of wealth and assets in American history. And in this video, I'm going to dissect this issue for you, revealing exactly what's unfolding. Please hit the like button to ensure this content reaches more people and educates them about the state of America's real estate market and economy. Now let's delve into some statistics. In 2022, a staggering wave of over 5 million homes were sold in the U.S. Interestingly, a quarter of these purchases were made by first-time home buyers. Their average down payment stood at 6%. It's crucial to reflect on this. If these buyers were to sell their property the day after purchase, factoring in a 5% realtor fee, transfer taxes, and closing costs, they'd immediately find themselves in negative equity. Many of these new entrants into home ownership find themselves in a disheartening position due to the dropping home values. Think about it. These home buyers anticipated a long-term commitment, but they are now witnessing a rude awakening. The market's adverse conditions have left many underwater, trapped in depreciating assets. Let's take a closer look at specific regions' struggles. Some of the largest markets in the U.S. experienced significant year-over-year declines. Memphis, Tennessee, for instance, saw single-family homes plummet by 17.1%. In Chandler, Arizona, the decline was less severe at 6%, yet it still ranks among the most affected areas. The repercussions of these losses are severe enough to threaten homeowners with negative equity, turning their once valuable assets into liabilities. The landscape is changing, and many homeowners find themselves in a precarious financial position. But what's even more alarming is the misconceptions many homeowners hold regarding their property's equity. They might see high values on platforms like Zillow and think their equity remains robust. However, sellers are starting to adjust prices downward, signaling a shift. In today's market, homes are unaffordable in 99% of the nation for the average American, with a staggering 52% difference between renting and buying costs. As the economic landscape continues to evolve, some sellers are becoming more desperate. With a limited pool of potential buyers, distress is becoming more pronounced. Let's take a closer look at the housing market and the economic indicators in the United States to understand the underlying trends. Consider the mortgage rates. 30-year fixed-rate mortgages are starting to skyrocket. When we analyze home ownership rates, consumer behaviors, and the overall impact of mortgage rates and borrowing costs on the economy, a pattern emerges. It's becoming increasingly apparent that people are reluctant to opt into buying homes at these inflated prices. Let's talk numbers for a moment. The average credit score in America is around 669. Now, if you're selling a property valued at around $450,000, the monthly payment is approximately $4,000. When mortgage rates were at 3%, That translated to a manageable $2,500, which most households with dual incomes could handle. However, as insurance and taxes continue to rise, managing these properties becomes increasingly challenging. Let's draw a parallel to the 2008 financial crisis. CNN reported back then that homeowners simply couldn't afford their homes anymore. They were witnessing a collapse in home values while facing skyrocketing costs associated with their loans. In our current scenario, although many loans might have relatively low interest rates, around 2.5%, 3%, or 4%, what's soaring are the ancillary costs: insurance, taxes, living expenses, utilities, and maintenance. These surges indirectly impact debt-to-income ratios and the ability to make mortgage payments. When we examine specific cases, it's evident how the current market conditions are affecting individuals. Consider this individual who invested in properties in Hancock Park, near downtown LA, worth millions. Now, facing the reality of the situation, he's left with no choice but to walk away from these properties, handing the keys back. Similarly, there's the case of Dwayne L.R., who bought a 2-bedroom condo for $340,000, yet the mortgage balance stands at $380,000. She's unable to refinance or sell the property due to being underwater, lacking equity to cover the shortfall. Some might argue that comparing the present situation to 2008 is extreme. However, let's consider the median home price in 2007, which was $246,000. Fast forward to today, and the median home price has surged to $412,000, nearly doubling. Yet, when we review median household incomes, in 2006-2007, it was around $68,500, whereas today, it stands at roughly $74,000, an increase of about $6,000 annually, or $500 monthly. However, when we factor in the drastic rise in expenses, it paints a dire picture. Take, for instance, the cost of a used car, which has soared from $8,000 in 2007 to $34,000 today. This inflation across various sectors highlights the financial strain on consumers. The year 2021 and 2022 saw a substantial injection of money into the economy, raising fears of inflation. Many individuals borrowed copious amounts, investing in tangible assets. While purchasing hard, real assets is usually a wise move, the crucial aspect is sustainability. Many are heavily leveraged, and as volatility looms, it's evident that not everyone will weather the storm. It's not just the 15 markets that have been hit hard. Even smaller markets within the top 100 in the U.S. are witnessing notable year-over-year price drops. For instance, San Francisco's condo market saw a staggering $122,500 decline in value within a year, nearly equal to the city's median income of $126,000. Even the traditionally robust markets like New York City's boroughs are experiencing declines. Condo owners in Manhattan face the prospect of selling for almost $70,000 less than the previous year's purchase price. In the Bronx, homeowners might have to settle for nearly $40,000 less than their property's previous value. Despite experts suggesting it's a good time to buy, I beg to differ. With impending student loan obligations, soaring credit card interest rates, and a struggling small business landscape, I anticipate more distress in the market. Renting might be a more prudent choice currently, as it's 52% cheaper than buying. Accumulating cash and waiting for better opportunities could be a wiser strategy. The key lies in positioning oneself financially to capitalize on the inevitable distress sales. In 2009 and 2010, astute investors capitalized on opportunities during peak fear. Similarly, I believe the best time to buy is when everyone else is advising against it. When your Uber driver is skeptical about real estate, that might just be the opportune moment. So, wait for that time of genuine panic when everyone seems to believe that real estate is a terrible investment. It's then that you might find incredible opportunities. Your initial real estate investment must be a vehicle to propel you from one point to another, building wealth along the way. Overspending on the first deal might compromise your ability to succeed in the subsequent ones. Thus, Waiting for that incredible opportunity, seizing it, and then leveraging the gains into the next investment might be the most prudent strategy. Now, let's delve deeper into the economic intricacies. As of late, the economic landscape has been volatile. With the rapid surge in inflation, borrowing costs have skyrocketed. This has created a scenario where many individuals find themselves over-leveraged, struggling to meet their financial commitments. We're observing a similar pattern to what transpired during the 2008 financial crisis. While mortgage rates might still be relatively low, the ancillary costs associated with homeownership, such as insurance, taxes, and daily living expenses, are spiraling upwards. This surge indirectly impacts an individual's debt-to-income ratio, thereby challenging their ability to meet mortgage payments. Moreover, the effects of these market conditions are evident in real-life scenarios. Consider the example of someone who invested in properties in the affluent Hancock Park area, near downtown LA. Facing the current market situation, they are forced to relinquish these properties and return the keys. Similarly, individuals like Dwayne L.R., who purchased a 2-bedroom condo for $340,000, now find themselves unable to refinance or sell due to being underwater on the mortgage. Comparing the present circumstances to 2008 might seem extreme to some. However, when we look at median home prices and household incomes, the disparities are stark. The median home price today has nearly doubled compared to 2007, while household incomes have only seen a modest increase. This disparity, coupled with soaring expenses across various sectors like automobiles, signifies immense financial strain on average consumers. The years 2021 and 2022 witnessed a substantial influx of money into the economy, sparking fears of inflation. Many individuals took advantage of low interest rates to invest heavily in tangible assets. While this strategy is generally sound, the critical aspect lies in sustainability. With a significant portion of the population heavily leveraged, the impending volatility may reveal vulnerabilities for many. The impact isn't confined to just a few markets. Even smaller markets within the top 100 in the US are witnessing significant year-over-year price declines. For instance, San Francisco's condo market experienced a massive drop in value within a year, closely paralleling the city's median income. Even traditionally resilient markets like New York City's boroughs are witnessing declines in condo and single-family home values. Manhattan's condo owners are facing the prospect of selling for considerably less than their previous purchase price, echoing a similar sentiment in the Bronx. Despite experts indicating that it's a favorable time to invest, I hold a different perspective. With impending student loan obligations, escalating credit card interest rates, and a struggling small business sector, I anticipate further market distress. Renting might currently be a wiser choice, as it's substantially cheaper than buying. Accumulating cash and waiting for better opportunities might be a more prudent strategy. The key lies in positioning oneself financially to capitalize on the inevitable distress sales. In 2009 and 2010, shrewd investors capitalized on opportunities during times of peak fear. Similarly, I believe the opportune moment to buy is when everyone else is cautioning against it. When your Uber driver dissuades you from real estate, that might just signal an opportune moment. So, await the phase of genuine panic when everyone seems to believe that real estate is an ill-advised investment. It's during that period that incredible opportunities might arise. Your initial real estate investment should serve as a vehicle to propel you from one point to another, accumulating wealth along the way. Overspending on the first deal might compromise your ability to succeed in subsequent ones. Hence, waiting for an exceptional opportunity, seizing it, and leveraging the gains into the next investment might be the most prudent strategy. Thank you, and stay tuned for our upcoming video.